Again, I'm traveling, so I'm up in the north of England at the minute, essentially assisting with some refurbishments and doing other bits and pieces. So yeah, I'm not as local as usual. So if you guys can hear me, just give me a bit of a chat. Okay, yes, awesome. Yeah, okay, you guys can hear me, awesome. So yeah, sorry, I know the sound isn't as good as usual. And likewise, the camera isn't going to be as good as usual. I am, as I just said, so I'm traveling. So I'm relying very heavily on the Mac sort of camera and sound equipment. So my apologies for not being quite as proficient as per usual. So thank you each and every single one of you guys this evening for joining the seminar or joining the webinar. This evening, we're going to be talking a little bit about below market value properties. More importantly, how to understand what a below market value property is primarily, how it works, where you get them, how you can get discounts, how it actually makes a difference to sort of your returns, your figures, what you're getting, what sort of outcome you're getting, so on and so forth. So yes, it should hopefully be a really good webinar for you guys, and hopefully you guys enjoy it. I've put a little bit of time and effort into making sure that this is laid out in a nice structured pattern as per usual. So I hope you guys enjoyed it, and thank you very much for taking the time. So let me first of all start off with explaining what is BMV. So typically I'd like to have my iPad out so I can go through numbers and figures with you guys. Unfortunately, I'm traveling, so not able to do much of that. And thank you for those of you that are joining as we speak. So to explain what BMV is, so BMV, below market value, essentially what that is that is a legitimate discount on a property. Now, legitimate, genuine discount. So if I explain what I mean by a genuine discount, it will hopefully make a little bit more sense. So if you were to buy a house that is estimated as being worth around £100,000 and you're buying it for £80,000, that doesn't necessarily mean there's a 20% below market value. There's a discount of 20%, potentially how you want to look at it, but it doesn't make it 20% below market value. Because if the property needs a £10,000 refurbishment, it's actually not 20% below market value. It's only 10% below market value because you're buying for 80,000 and putting in 10,000, bringing it up to 90,000 when it's worth 100. So you're actually spending around 90, including stamp duty, legal fees, etc. Though you can't really count those in figuring out what's below market value. But if you're buying a property, you have to take into account the refurbishment costs to be able to understand exactly what percentage it is below market value. So below market value as a term essentially signifies what are you buying the property for as a percentage of its value at that point. Okay, so if a property is worth 100,000 in good condition, but you know you're going to need 20 or 10,000 to get it into that condition, you know it's probably only worth 90,000 at that point. Okay, that's kind of how you can estimate what its actual value is at that point. And if you're buying it for 80,000, you know you're buying it for 10,000 below market value. Okay, so that's the easy way to be able to explain it and sort of make that make sense. Now, in terms of the figures you need to account for, and this is something that I think sort of it's often underestimated. So when you're calculating out what is below market value, the only figures you really need to figure out is what are you buying it for, what is it worth, and how much is refurbishment to get it up to that value. Okay, that then enables you to be able to signify what is your percentage below market value. But there are other things you need to be considering. Okay, so there's always other figures, other maths that you need to be considering in every purchase. So some of the other figures you always want to be considering is you've got the basics. So you've got the standards like, you know, your legal fees, your brokerage fees, your lending fees, stamp duty, etc. One of the other fees you need to be accounting for is your sourcing fee. So how much are you paying to acquire that property? Often people will overlook this. So they'll say, oh, well, you know, I don't pay any sourcing fees. I find the properties myself. And it's like, okay, so if you find it yourself, that's absolutely fine. How much time has it taken you to find their property on your own? If you found their property on your own, how much effort, how much fuel, how much, you know, food, how much travel, etc. So then what you need to do is you need to calculate what your actual time expended is. And this is something that a lot of people do is they go, oh, well, you know, I source to myself, therefore I don't account for any sourcing fees. It's like, well, you're kind of creating a bit of a false economy, because then what you're doing is you're saying your time is worth nothing. Okay, and I'm pretty sure you'll all agree your time is worth significantly more than nothing. Otherwise, you wouldn't be sitting here doing this trying to free up your time. You know, you're trying to do that because you're trying to relieve your time so that you can actually not have to spend your time on stuff like this. So if you then go, okay, well, how much do you typically get paid an hour? It's like to say £15 an hour or £20 an hour, whatever it is you get paid an hour. And you go, okay, well, including your travel time to the locations and all of the properties between deals. So let's just say every 15 properties you go and negotiate on, view, inspect, discuss with sellers or whatever else. So every 15 properties that you go and inspect, create one deal for you. Okay, those 15 properties, the amount of time that it's taken you to do this, and I don't just mean the physical viewing, I mean your travel time, if you've had to stay overnight, what's the cost of that? So the total amount of time allotted from point of one deal through to actually getting the next one through, that amount of time you've actually employed, also the amount of fuel that you spent, the amount of food, any lodging costs if you have to stay for hotels, so on and so forth. So all of these things are all costs to you to be able to acquire a property. Okay, so although sourcing fees, some will just go, oh, well, that's me paying a sourcing agent. So that is one type of sourcing fees. If you're doing the work yourself, you also have to account for what are the other sourcing fees that you're employing. So, if you spend 50 hours to go and find a deal, how much of those 50 hours worth of real life time, if you're charging yourself £20 an hour, okay, you're talking, what's that, £1,000, just for that, plus then any fuel, any food, any lodgings, and so on and so forth. So it's some of the things to consider. These are still sourcing fees. So in terms of figures to account for, obviously you want to be accounting for what you're buying the property for, what the refurbishment is as your base to be able to figure out your below market value. The other items you want to be considering is your legal fees, your stamp duty, your brokerage fees, your lending fees. If you're buying or bridging, what's the bridging fees, set up and exit, and also your sourcing costs. So these are the fees that you want to be accounting for typically for every purchase that you're doing. Okay, very useful to always make sure you look at that. And I find it very important to say that, and the reason is very simple. So I've got, so we obviously, as many of you guys will know, so we used to run a training company. Had a couple of hundred direct one-to-one mentorship students we worked with, literally trained tens of thousands of people from stage events and so on and so forth. And often people completely mistook the whole cost of getting a deal. So it's particularly interesting. So you got certain types of people, so people who tend to find themselves, they feel like they're very thrifty, they're very efficient with their money, but what they're willing to do is they're willing to trade a lot of time to be able to save that money, when in reality, had they utilized that time in their job or in their work or whatever else they do to be able to earn, they probably would have made significantly more money than the amount of money they saved by not having to pay a third party to do the work. And the prime example of this is, let's just say, if I give you an example, let's say cleaning, right? So you might say, well, I don't want to pay for a cleaner in my house because if I pay for a cleaner, right, then it means that I'm now paying somebody £10 an hour to come and clean my house. And I can clean my house and I don't have to pay them £10 an hour. So I'm saving myself, I don't know, £50 a month. The reality is that 5 hours that cleaner has spent in your house, had you been earning £20 an hour, you could have only worked 2.5 hours in your job and you would have paid for twice the amount of cleaning. So the logic doesn't make sense. And unfortunately, it's very much a saver's mindset as opposed to an investor's mindset. And it's just something I think is always worth mentioning, because a lot of people, they don't take into account how much time are you investing into building your portfolio. And we call this sweat equity. When, if you have the capital available, had you invested that capital, you could have utilized your time elsewhere more efficiently or better, and actually focused your actual energies and time on higher generating items. So, bigger cash flow generating items. Something just to consider. Now, so this is one of the items that comes up quite a lot. And for me, the beauty about buying at below market value, so buying a property where you're getting it for a bit of a discount, the wonderful thing about this is you're essentially creating profit from day one. Okay, that's in essence what's happening. So imagine you were to buy a property and you buy it and you're spending £25,000 to buy it. Okay, that'll be your deposit, your stamp duty, your legals, your brokerage, your sourcing fees, all of these other costs involved. And you're into the deal for £25,000, but you have equity of £40,000. Okay, so what that means is you have real life just created £15,000 worth of value, worth by having bought that property at the right price. Okay, and a lot of people get completely mistaken by this, and this comes up a lot. So if I give you a bit of an example, if you bear with me 1 second, and I will show you. So I'm just going to go pick a property at random. If I do a new share, I'll do Safari over here. Okay, so let me just, so I'll just pick one at random. So let's just say this property over here, Ainsley Street. So, you know, a good little investment property. This is over in Barrow-in-Furness. Hopefully you guys can see the screen well. So this property over here, we're expecting a refurbishment of circa £5,000. Okay, the property is actually rented. It's a good rentable condition. As far as I'm concerned, yeah, so we got a tenant in situ. So, you know, there's a tenant in there. Yeah, they're paying, let's see what they're paying. So they're paying £550. And we believe the market rent is £550. So they're actually paying market rent, which is brilliant. So it makes it a really easy one. The yield isn't amazing. That's okay. But by you buying this property at £126,000, literally the day you buy it, okay, and it's worth £155,000, let's call it, you've basically created £29,000 worth of value. Okay, you've created value of £29,000. Now, the reason I say this is people often get caught up in the in what we call an illusion. Okay, so if you were to buy this house for 155,000 instead of buying the house for 126, so let's just say you buy it at market value. People go, yeah, but you know, I want to make sure that I've got my you know, my brokerage fee, my legal fees, my stamp duty fees, all of these sort of things covered up. And I'm like, well, then to be able to do that, you would have had to have bought it for below market value to make sure that they are actually physically covered. Okay, because if you buy the house at market value at 155,000 and there's no refurbishment, so let's say there's no refurbishment, you're actually going to be into the deal for circa 160 because you've got your legal fees, brokerage fees, stamp duty, you know, sourcing fees, so 160, 165. So you're going to be into the deal for a lot more because that is the nature of having bought it at market value. If you buy this property below market value, okay, because you don't tend to account for all those things, because those extra costs are extra costs, they are on top. You can't account for them as being part, you know, a requirement for you having bought the deal. They are an on top. So if you buy at market value, you're into a deal for 160, 165 when it's worth 155. That's what it is. That is standard. Okay, now if you buy this at a discount, and let's just say you bought this house for 145 and all of your other fees, etc., cost you 10,000, now you're into the deal for 155, you've still bought that for a discount of £10,000. And this is something people often don't account for. They go, oh yeah, but you know, if my, you know, my fees and blah, 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 therefore it's not really a discount. It's like, no, it is a discount. What you've just done is you've managed to buy it cheap enough to have all your fees covered off by having bought at the right price. Okay, and I raise this because this comes up a lot. So as an example, you're buying this for 126, it's worth 155, give or take. You know, you're getting a £29,000 discount. Sure, you've got brokerage fees, legal fees, stamp duty fees, etc. And you're going, okay, well, now all of a sudden it's not 29,000, it's now, you know, 23,000 or 22,000, whatever it is. And then you've got your refurbishments. Now it's only, you know, £17,000. It's like, no. You still bought this for a discount of 29,000 minus your refurbishment, so 24,000. That's what you've done, is you've saved yourself £24,000. You've literally created that in value by having bought this, so this is the right price. So buying a property like this, okay, if you look in terms of your figures, your total investment in this property is about £43,000. But because you bought at the right price, and this includes refurbishment, but because you bought at the right price, you have created a saving. Okay, created a saving of the £29,000 difference minus the 5,000 refurbishment. So £24,000. So you've bought this for 43 and you've saved 24. So you've saved an extra 50% on the purchase just because you managed to buy at the right price. Okay, and this for me is very important. Now, the other side of things to consider is if you're buying for 126, you're spending your refurbishment and stuff, you're in for 131, including refurbishment. Okay, but the property is worth 155. Okay, what you've done is you've created that extra equity. So you might be into this deal for 43,000, but the amount of equity you've got, okay, is not 43,000. The amount of equity you've got is probably circa 60,000, 70 or 65,000, give or take. So you've made over £20,000 after taking into account your legal fees, your stamp duty, your brokerage. You still created the value of an extra £20,000, give or take. Okay, now for me, that is fantastic, because essentially what you're doing is, that's like going to a poker table, okay, and saying, if I put my chips down on this one here, I know as a fact I'm going to make an extra 50% on my money just by putting that down there. No matter what happens, I'm making 50% of my money. That is essentially how the whole below market value thing works, is you are buying and creating an intrinsic value, having bought at the right price, because that value is still there, it's yours. If you were to then sell the property, okay, you would be able to sell it for 155, and you've got the difference, right? That money's yours. All of a sudden, it's not 43,000 that's coming back. You're getting 65,000 pounds coming back to you as part of the sale of that property. So you've created that in value. And this is something that comes up a lot, and really is a big conversation, because people don't get it. They go, well, oh yeah, but I bought for a discount, but I'm still 43,000 in. It's like, yeah, you're 43,000 in, but then when you refinance the property at the higher value later down the line, you're only going to be 30,000 in. You're not going to be 43,000 in. So the amount of money invested becomes significantly lower, which means the amount of return that you're making is significantly higher than what it typically is. So it's a really, really useful thing to understand. And the power of discount is, honestly, it's unbelievable. So you've got to make sure when you're looking at discount, you're actually accounting for how the actual discount looks, as opposed to just getting caught up on the minutia of, yeah, but I'm spending this on brokerage, I'm spending this on legals, I'm spending this on this, and I'm sure I bought it for 126 and it's worth 150, but it's still only 120. And it's like, no, you've just created that value. So anytime you get an opportunity to buy a property for a legitimate discount, where you get to create money, you are literally buying with your profit made. Okay, buying a discounted property, you've made your profit. You've already bought the property with the profit in. That's like me giving you a winning lottery ticket. Okay, you go, well, that's 10 grand to buy that lottery ticket, but I know I'm going to make 15 grand having bought that lottery ticket. You've already bought it with the profit in there. Okay, and that's the beauty of buying for a discount, is you can buy a property knowing you've created the profit, knowing you've made money from day one. And a lot of people get really stuck on this. So I had a very long conversation with one of our clients and investors yesterday around what he's looking for. So he's buying a property for a 30% discount, which is unbelievably good. It's tremendous, really, really good discount, 30%. And he says, yeah, I don't know if it's the right one, because the yield is only 7.5%. I'm like, are you freaking mad? And he's like, what do you mean? And this is why I wanted to have the topic that we've got going today, is because this conversation comes up a lot, where people, they don't seem to grasp the fact that, making your cash flow, and cash flow is king, 100%. You need to make sure you're making an income from the property, and you want to make sure you're making good money. But people get so caught up on only making cash flow that they don't seem to notice the discount. It doesn't even compute in their head. So if you're buying a property and you get a legitimate, genuine discount as part of the purchase of that property, you have created that money. That is profit from day one. Cash flow is ongoing profit. And it's great because it feeds you, it gives you money, it's everything you need to do. And you need to build a portfolio that has good cash flow. Absolutely, I completely agree. But you can't then just ignore the profits you make on day one for buying for a discount. You're buying anything with a 10%, 15%, 20, 25, 30, whatever discount, buy it, because you are creating wealth. You are creating profit. Okay, that you're literally taking £5, and at the same time, that £5 has now become worth £7.50 or £10 because you've spent that £5. And you knew when you spent that £5 would be worth £10. And that's the whole value of discount below market value. And a lot of people, they don't seem to get this. If I were to say to you, if you give me £10, your £10 will instantly be worth £20, but you have to give me that £10. But I guarantee you 100%, there's a contract, you own it, there's legals, there's charges, there's everything, so that you know for a fact that your £10 has just become £20 on the day that you spent that money. Okay, you'd go, well, of course I do that, because I've just doubled my money, or I've added 50 or 70% or whatever it is, purely because I've invested that money into buying the right asset or invested in the right place. Buying for a discount is exactly the same thing. You are buying a property with profit built in, literally from day one. And a lot of people miss this. Okay, so I appreciate I've really, really harped on about this, but for me, it's a really big thing for you guys to understand. Okay, now, it's all well and good me going through what below market value is, how it works, how the profits work. so on and so forth, and being able to essentially create money out of thin air, because that is what that is. You're buying something and you have created value purely by buying it for the right price, right? You've got a car that's worth 200 grand, you're buying it for 100 grand, it's worth 200 grand, you've just doubled your money by having bought that car. Buying a house is exactly the same way. The house is worth 150, you've bought it for 120 and you've only had to put down a certain amount of deposit. Therefore, if you sell it, you've doubled that money that you initially had. You've essentially done the same thing. So you invested 30,000 and now your 30,000 is worth 60,000 or 50,000. You've done exactly the same thing as having bought a car and then, essentially resold it at a higher value. It's very, very similar. So it's all well and good me going through what that is and how those deals work and how the numbers work, etc. But if I don't go through how you can find some really good opportunities like that, of course, there's no point, because you go, well, it's arbitrary. It's, for me, understanding what it is and understanding how it works is fine. But if I don't understand how to be able to get those opportunities, then there's no point me doing it. So what I'm going to do is I'm going to give you a very quick route to how you can get some of these, and then another quick route on how you can get some of these. Okay, so to get the best below market value properties, there's a couple of main routes to market. Okay, so route one is you take a look online and you go through the typical investor route where you spend a whole bunch of time on Rightmove, and every property that comes up with an area, you go and you analyze each property. You go, okay, well, the property's on the market for this. The sold comparables of similar types of properties within the local area is this. This is the price difference. Therefore, if this house, if it typically sells for 100,000, and it's on the market for 60,000, all I've got to do is figure out what my refurbishment cost is, and then I know what discount I've got. But if it's on the market for 60 and I know it's worth 100 in good condition, I've probably got some room for maneuver. Even if I spend 15, 20,000, I'm still making good profit on having bought that property. Okay, so that is route one, where you essentially spend hours and hours on Rightmove. And we had actually built a technology that did all this, ran our own automated valuations, put every single property on Rightmove. We actually got them listed in our database right now, automatically valued, and then we know what the property's worth and how much it will sell for and what it's currently on the market for. And that differential is how we essentially found great opportunities. And that's how we actually built our portfolio between 2015 and 2018. Multi-million pound portfolio, I think it was like 3, 4, 5 million, something like that at the time. So, we built it very quickly, and that was the model that we used. So we used the online method. The second method you can use is what we call off-market, okay, the off-market method. Now, the way in which the off-market method works is you essentially do something called bandits marketing, okay, or guerrilla marketing. There's a whole bunch of terms that people use. And there's some really big names that essentially tout how to do this stuff. Some are better than others, but essentially what you're doing is, you've all seen the boards that say, oh, we buy any house, or any house, any condition, or, we buy for cash, or, all these different things, right? And you've got these big funds and family offices and investment firms that, they spend millions on essentially sending out flyers and letters and all these things to all of these houses in these investment areas, where essentially what they're trying to do is gather leads. They're speaking to people. And those people then come through, they say, oh yeah, I've got your letter, and your letter says you'd buy my house for cash and you buy it at a good price. So, I might be interested in selling my house. How much would you buy it for? And it's very much like the we buy any car model, where, the investment fund would say, they would know the house is worth 100,000 and they'd say to sell, oh yeah, we'd happily buy a house for 70 grand in cash and we can complete in 2 weeks or 4 weeks or whatever you want. And the homeowners, in probably 1 to 5% of the time, would go, oh yeah, okay, that's fine, yeah, I'll take that. Okay, most of the time, I'd say about 95 to 98, 99% of the time, they would say, oh no, I want to sell it for 90,000 or 95 or 85, whatever it is, which doesn't quite reach the criteria of the fund. So a lot of our stock that we actually get through large investment houses and large funds, where essentially the properties aren't discounted enough for them. So they then feed it to us, and then we manage to be able to essentially list it with a 20, 25% discount, whatever it is, so that you guys can buy really good investment properties without having to spend the same sort of marketing money that the funds have to spend for each lead, for each property that comes through. Okay, so that's kind of how that model works. So you'd be sending out a lot of letters or a lot of flyers. You have a lot of things listed up, putting in postcards in shop windows, or we buy any house in any condition, or, you do email campaigns, or, whatever it is. So you do this massive campaign of marketing to essentially generate leads where people are interested in selling their houses. And then what you do with those leads is you pick up the phone, you have a conversation with them, you figure out, you have your basic due diligence, you know what the house is worth, and you figure out what your offer is going to be. And then you'll either have a call with them, or you go sit down, have a cup of tea. And honestly, you always drink the tea, and the amount of crap cups of tea I've had over the years doing this is obviously it's ridiculous. And honestly, some of the teas are really bad, and you always have to drink the tea because you don't want to offend the person, because you want them to see the best in you for them to sell the property to you. They're not going to sell the property to you if they, oh, he didn't even drink my bloody tea. So you end up having to go through this guerrilla marketing, and the amount of time and effort and energy spent in talking to all of these people interested in selling. I'm not talking about, friends and family, because everyone will occasionally be able to get a friends and family deal that they might be able to buy for a good price. But the reality is, it's the strangers market that's kind of where you need to be spending time to be able to get any sort of real volume that makes enough sense. So that is method 2, which is essentially guerrilla marketing and face-to-face negotiating with people. And these people will be emotional. Oh, well, I bought the house 20 years ago for, 60 grand. And, I know it's worth 120 because next door sold for 120, but I don't want to sell for 120. I reckon I can get 130. And you're going, mate, like, the house is only worth 120. And he's like, well, maybe I'll take a bit of an offer, maybe 115. And you have this whole drawn out dialogue, and eventually they go, yeah, it's fine. Yeah, I'm happy to sell. And you want to move forward with the purchase, and everything seems to be going great now. Oh yeah, no, my brother, he said he'll buy the house. I'm selling it to him for 100, but it's okay because he's my brother. And you're like, dude, like, I've spent weeks and months, talking to you and organizing this and arranging, and I'm into legals and all these sort of things. So, that route, the off-market route, is a very, very tough route to be able to do on your own. And you'll typically find, unless you live in the investment area that you're looking to buy, okay, it can be quite time consuming, quite exhausting. But yeah, it's the second route. The third route, which is actually the simplest route, is you pay somebody like us. Okay, so you would pay a sourcing agent, somebody who has access to a lot of properties. They've got really good discounted properties, or they've got properties that have got great yields, or they've got HMOs, they've got stuff in the right areas that you like, stuff that you can convert to serviced accommodation, or stuff that you can get a guaranteed rent on, where you've got a housing association that would take it on. These sort of properties, and we've got, I think it's 2,800, 2,900, near enough 3,000 properties, a little over 600 million pounds worth of property we've got available now, and we're slowly but surely uploading it all onto the site. So what you do is you go to a site like ours and you take a look and you go, oh, I can see this one's worth, the Zoopla valuation's 150,000. I've researched it. I think it's only worth 140, but I can buy it for 105. And they reckon maybe it's around a 5 grand refurb. So I'm all in for 110, but it's worth 140. So I've made 30 grand the day that I'm buying this property, but I have to pay them 3 grand for the privilege of making 30 grand. And I'm like, well, I'm sorry, but if somebody wants to make money, and if you pay 3 grand to make 30 grand, so you only make net 27, that's not a bad position to be in. Okay, so we do all the heavy lifting, all the donkey work. We've got all the relationships. We've got, we can help you with the lending, with the brokerage, with the legal fees. We can help you with setting up companies, property management, bookkeeping, accounting, finance. So we can do all of that sort of stuff for you. Refurbishments, the whole kit and caboodle and shebang. And there's a small fee to pay for that service. But what it does do is that enables you to be able to get access to amazing off-market property. And what you're doing is you're paying a small amount without having to then go and physically find the properties, pay for all the marketing, go set up with all the sellers, go drive to their houses, drive around, doing all that sort of stuff. You can essentially say, well, actually, let me just shortcut it and I'll pay this person to do it. And it's no different to a mechanic or anyone else. You go, well, this is somebody who, they have their expertise in that field. They've done over 1,000 properties. They've built portfolios for, hundreds of people, and that's what they do. So, I'm happy enough to pay a small amount because I know it's going to be much quicker, easier, and successful with them than it would be had I to go and do it myself, because I'd be stumbling around figuring it out. For those of you that, as an example, have done, work on the house or, work on your car, whatever, and it's not your field of expertise, so you might go, oh, I'll just paint the room myself. It's no problem. I'm not going to get a painter and decorator in, and it takes you 12 hours to get a room all fitted out, all painted, all nice. And, the lines aren't quite perfect, but they're okay and they're passable because you've done it. And you go, well, that's taken me, 12 hours. And in those 12 hours, if I'd have worked, I could have earned, 240 quid or whatever it is for those 12 hours. And you could have paid a painter and decorator 150 quid. You go, well, technically I'm 90 quid worse off, and I've done a job that is not at the same standard as what they would have done, and it's taken me significantly longer, because had I just paid them, they could have had it done in 2 hours rather than me spending 12. So, you know, there's the whole false economy thing, and it's just something to consider. So that's essentially how we operate, is we will then go and find those properties for you and do all the donkey work. Now, the beauty is you can essentially pick and choose. So as an example, if you take a look at what we have on our site, I think I just showed you guys an example. So this is our site. If you haven't been on there before, just head to trustbricks.co.uk, and you'll see there's like a whole bunch of properties. You got, you know, although it says like 0% discount, these are typically HMOs. So if you see, the yields are unbelievable, like 15% yields and stuff. So you're buying an existing HMO operational, and you'll be making significantly more money on a monthly basis, which is why it shows there as a 0% discount, because it's you know, it's a high yield asset that's going to make you a lot more cash flow. So you're buying it for a different reason. But like stuff like this, Newton Road, 41% discount, you know, 12% discount, 15% discount, 46% discount. You know, you've got a whole bunch of apartments, you know, 10, 11%. 13, 14%, you know, 10%. So you've got all sorts of stuff, you know, really good discount. And you've got some stuff that doesn't have a lot of discount, but you're buying it with a great yield. You're getting existing HMOs, or you're buying stuff in Croydon, so further south, London based. You know, we've got blocks of apartments. So let me see if I can show. You know, and we're slowly but surely listing this stuff on here. So you can see, like, these are some of the things we have. You know, so we're showing 4 blocks of apartments in here. So this is Gravesend, Knightsbridge block of apartment. You're getting a reasonable yield, 4%, which is okay. Net cash flow on a higher interest rate. I actually need to look at the numbers, because I'm pretty sure it's a little bit better than that. But it just gives you a bit of a flavor. So you can buy, depending on what you're looking for, much bigger blocks, much bigger items, or you can buy smaller. You know, Neesworth, this is over in Royston, which is sort of Cambridge way, if I'm not mistaken. You know, this is over in Leeds. This is, unfortunately, it's reserved, really good yield. This one as well, fantastic yields, but just gives you a bit of a flavor, right? So that's kind of one of the ways in which you can operate, is you just go onto the site and there's a whole bunch of information in there for you. Now, one of the things to consider, and it's something that a lot of people don't really understand, is whenever you're buying a property below market value, there's typically a couple of reasons why you're buying it below market value. It's either a distressed property, i.e. the property needs refurbishing or tidying up, or it is a distressed landlord, distressed seller. Okay, so when somebody is selling a property, they might have been repossessed, or going through repossession, or going through divorce, or going through some other personal challenge, meaning they have to sell a house for a big discount. Okay, therefore, you know, also they have to sell a house very quickly. Therefore, they will give you a discount if you can buy their property quickly, and therefore relieve the pressure for them much quicker, because they're like, look, you know, I might be giving away an extra 10 or 15 grand. I don't really care. I just need to get shot of it really quickly, because, you know, I'm going through divorce and I need to separate and whatever else it is, you know. So that whole conversation, you know, people might be distressed personally. The alternative one is a distressed property, where the property needs refurbishing, 5, 10, 15,000 pounds worth of refurbishment to get it up to a good rentable condition. Again, the term is rentable. Okay, so if you're buying a property up, you know, in the far reaches of the north of England, you're not going to be refurbishing the property with, you know, granite worktops and, you know, expensive kitchens and expensive bathrooms. You're going to be refurbishing the property to a standard for the area. You know, if you're investing in a 2-star area, you're not going to be doing a 5-star finish or a 4-star finish. You know, you're typically going to do like a 2.5-star finish, so slightly better than required within the area, to make sure that will always rent out properly and the people respect it and treat the property well. So that's one of the things to consider. Now, when you're buying a property that is a distressed seller, you can typically buy it on a mortgage without any complexity. The only thing to consider is if you're buying on a mortgage and it's a low value property, okay, what you'll find is then you're probably going to have to wait till the nearer the end of the mortgage term to refinance that property and release some of that equity. Okay, so you might be on a 2-year mortgage term or a 5-year mortgage term. So it might take you 2 years, 2.5 years for you to release the equity from that house. So it may take you longer to do so. However, if you buy a house that is in a distressed state as opposed to a distressed seller, you typically be buying this property either cash or bridging. Okay, now bridging finance, for those of you that never managed to attend our event that was sponsored by Somo Bridging. So bridging finance, very simply, is like a high interest mortgage. They care less about the quality of the property. They care less about your personal circumstances. They care less about a whole bunch of stuff. because instead of them charging you a 5% interest rate, they'll charge you a 10% interest rate. They'll charge you twice as much, knowing full well that you're probably going to use them for about 6 to 9 to 12 months. And in that time, the property is going to be taken from a worse condition into a better condition. And there's going to be some refurbishments and works or whatever else is going on. So they will charge you more for them taking a larger risk on you. So this is what we call bridging finance. So I put in here different lending based on refurbishment etc. is to make sure that some of you guys are aware that, if a house needs like £5,000 worth of refurb, you can typically buy on a mortgage without any challenge. If the house has damp work that needs doing, normally what a mortgage lender would do is they would give you a retention, which means they'll say, we'll lend you the 75,000, which is 75% of the value of the property, but we're going to retain 10,000 until you've done the damp work. And you go, oh, okay, fine, you do the damp work. They send a valuer out, the valuer goes, oh yeah, the damp work is done. And then they will release the other 10,000 to you. Okay, but if you're talking, 10, 15, 20,000 in terms of refurbishment, you're probably going to struggle to get a conventional mortgage, and you're probably going to need to get yourself a bridging loan or buy in cash. I always recommend bridging loans over cash. And if you need a connection, I can connect you to Michelle Lowe. She's fantastic over at Somo, and we can get you preferential rates, which is always nice. They also do a refurbishment product where they will lend you the refurbishment money and they'll just secure it elsewhere. So it's quite a handy little thing to do. Okay, so that's why I sort of mentioned this, because a lot of people go, oh yeah, I'm just going to buy it on a mortgage and refurbish it, and it's like a 20 grand refurb. I'm like, well, it's not going to work, because a mortgage lender will not allow it. They want the property to be in a certain level of standard or certain condition before they will lend on a conventional mortgage. Okay, cool. So that's sort of that whole piece there. Now, to give you a little bit of an example of a really good deal where you are essentially creating money from the day you buy it. This is a property over in Newton Road, St Helens. So this forms part of a portfolio that's been repossessed. The seller needs to sell. Okay, so you're getting it for a really good price. Okay, she's going through, she's literally in court, going through the whole judge thing, so on and so forth. I can't go too much into detail, but essentially there is a repossession order happening with this property. And we've got a handful of them like this. So this property you're buying for 95,000, probably needs 5 to 10,000 worth of work. We've been told it needs a little bit of work, okay, which is fine. The cash flow and the yield isn't great. I'm pretty sure you can get a higher rent for this. 395 sounds very cheap for St Helens. I'm pretty sure you can probably get around 550, 600 for this. But we put down 395 because that's what it's currently rented out for, which tells me the property is probably in need of a little bit of work and certainly is an underperforming asset. Now, although you're buying it for 95,000, Zoopla value is at about 161. I reckon it's probably worth around 150-ish, maybe 160, sort of somewhere in that mark, but it's Zoopla, so obviously do your own research. But even at 150, what you're doing by buying it for 95, you spend 5 grand on refurb, you're into it for 100. If it's worth 150, you've just created an extra 50 grand. Okay, you've made 50 grand profit the day you bought that property if the refurb's 5 grand. If the refurb's 10 grand, you've made 45 grand profit. Now, if you're only investing 35 grand into the property and you've made 45 grand's worth of profit, you're more than doubling your money purely by buying this house. And all that's happening is you're going, I want to buy this house. And as soon as you complete on this house, you've doubled your money. That's literally how it works. You've literally created money out of thin air. So for me, deals like this are a no-brainer. As soon as you get over 20% discounts, like it's one of those, if you've got the cash available, just fricking buy it. Don't fanny around. Don't sit on your hands. Don't, oh, well, I want to double check. I want to think about it. I want to do this. I want to do that. For me, it's really simple. Get on the site, reserve the property. Okay, that's it. When you reserve the property, for those of you that are new to this webinar, and we've got quite a few people of you on here. So thanks to all of you that have attended. If, oh, shoot. There we go. So for those of you that are new, essentially how we operate is we take a small reservation fee to make sure that people are serious. You would be amazed at how many people say, oh yeah, I want to have that property. Yeah, I'm definitely, I'm keen to buy. I want to, and then they go view the house and go, oh yeah, this one's not for me. And then they go, oh, well, actually, I want to go see that one. And we take them out to that one, and we, take the time. I pay the team to go and book everything with the seller or book everything with the agent. So we got off-market agents, we got funds, we got all these people. Booking everything with them, then our team goes and attends with, so we've got to pay them for fuel and for time and all these bits, and the people go, oh yeah, I don't want to buy that one either. And they view 3 or 4 houses and you go, look, what do you want to buy? And they're, well, I'm just curious because, I'm going to have some money in 6 months time. So I'm just curious. And he's going, so what you're doing is you're just wasting my time and wasting my money. That's all they're doing. So What we do is we take a small reservation fee. It's literally £500. You're spending 35 grand on buying a house. £500 is nothing as a reservation fee. And that fee is 100% refundable. So it is literally there just to prove that you are not a time waster and that you are legitimately looking at buying a property and legitimately interested. Okay, at that point, I will connect you with our team. Our team will then organize a viewing. You can attend or not attend, it's down to you. We will supply you with a video walkthrough, and we will also supply you with a full written quote of everything that's needed to do in that house to get it up to a good rentable condition. At that point, you will have a choice. You can either then say, yes, I'm happy with that, I would like to move forward with the purchase, or no, I'm not happy with that. I would either like to choose a different property or I would like a refund. If you'd like a refund, we'll hit refund, literally straight in Stripe. The refund will be in your bank in the next 2 to 3 days. It doesn't take very long. If you would like to move forward with the purchase, we then charge the 50% of the sourcing fee. Typical sourcing fees is $3,000 or 2% of the purchase price, depending which is higher. And at that point, you're into the deal. And that's it. We will assist you. We'll connect you with solicitors, with brokers, everyone you need all the way through to completion. We'll assist with the refurbishment, tenant finding, property management. If you really want, we can also even do all your finance stuff, so bookkeeping, accounting, taxes, filing returns, all that stuff. So we can kind of do everything. So that's how it works, right? So the real question is, do you want to make money? If you want to make money, a deal like this is the perfect way to make it. Even if you do your research and you go, oh, you know, I don't think I can make more than 140,000 in value on this. Doesn't fucking matter, because you're still making 30,000 or 35,000 or, you know, 40,000, whatever that figure is, in terms of having bought this deal on day one. Okay, so do a little bit of research by all means, but between me and you, shit like this needs to be reserved. The fact that it has been on the site for more than 3 days. Yeah, so it went on the site on Monday. So out of this portfolio, I think we've sold 7 now out of the 14 of the portfolio in the last since Monday. So Monday, Tuesday, Wednesday, and then Thursday. So over the course of 4 days, we sold the 7 properties out of the 14. Okay, this is one of the very few that's left. And for me, the fact that this is still available astounds me. Okay, absolutely astounds me. It's mental that people are going, well, maybe I sit on that, maybe I don't, maybe. And I'm just like, dude, go raise the frickin' money, buy it. You're making money. It's free money. That's it. That's how it works. It's free money. So anyway, so this is a prime example of a really good deal we have available right now. Between me and you, if you have the capital available, I'd be on the site right now reserving this. That's what I would be doing. Okay, cool. So if you guys wanted to check out any of our other deals, head over to www.trustbricks.co.uk. If you have not registered on the site already, okay, when you go on and you click through on a property, it will ask you to register. Registration is completely free. We do it purely so that we can track who's who, and we can start to send you suggested properties in time. Okay, so that's all it is. So then you get all the information on the property. Like I said, there's no cost doing that. If you're interested, click reserve, take you through to a payment link. You can reserve and off you go. Very, very straightforward and very simple. If you want to check out any of our stuff on social, so we do a weekly webinar, we do a once a month face-to-face, we're running in London. So this one is also around how you get discounted deals. So we're doing a whole 2.5-hour session, I think it is, on below market value, some of the opportunities we have, some of the opportunities we've got coming through. And it's a real big showcase of a lot of the stuff we've got. And we also put on some free drinks for you guys as well. And it's a free event, there's no cost. So if you would like to attend, just check out, get registered. You'll be receiving emails on it. Get yourself booked in. It's in London. It'll be at Homegrown on the 24th. I think it starts at 8 p.m, runs through till 10. So absolutely worth getting yourself booked in for that. That'll be a really good event. But we've got a whole bunch of content that goes out on our socials, including about the live events, the face-to-face events. We call them IRL events, which is in real life, because this is very different from in real life. This isn't really a conversation. This is me speaking to you. And I don't really get a lot of feedback from this, you know, even though we've got quite a few people on this evening. So, you know, if you want to check out any of our socials, we've got Facebook, Twitter, LinkedIn, Instagram, you know, YouTube, so on and so forth. Obviously, we are live on YouTube. So do feel free to go and check some of that stuff out. It's really good. You know, we've got 36 videos on there now. I've been running that for a good number of weeks now. So we've got a ton of content on there, where to invest, when to invest, how to invest, where we are in the cycle, you know, where you get the best deals, what HMOs are, housing association, how to get into that, how to get guaranteed rents. So you've got a whole bunch of really useful content on there. So please do go check out our channel. Obviously, do follow us, do like and subscribe to the videos. I do appreciate it. It helps the channel grow, helps us reach more people. Okay, and finally moving into the end of the presentation where I'm going to go into a bit of a Q&A. So often we don't get many questions at this point, which is fine. I'm okay with that. But I do want to open this up. I have spent many, many years coaching and mentoring people on how to build their portfolios. So if you have any questions you would like, essentially like us to answer anything, like us to talk through anything, then please do ask the question, whether you're on YouTube or on Zoom. Please do ask any questions you have. I'm more than happy to assist. I will obviously jump on any question you have. If you have no questions, not a problem. Do me a favor, just give me a bit of a thumbs up or no questions or anything in the chat. It'll make it much easier for me to be able to know that there is no questions rather than I'm talking into a vacuum. So if you can do that, that would be awesome. But otherwise, it seems there are no questions this evening, which is awesome. It means I have efficiently and effectively covered the content in a way that you guys all understand everything I've said, which is excellent. If you guys have anything that you would like to raise outside of this presentation, or you'd like to have a conversation with me personally, please do reach out. Obviously, you can reach out at contact@trustbricks.co.uk, or comment on any of our YouTube videos or any of the other videos, or reach out directly through the website. I am more than happy to assist you in building your portfolio or whatever it is you need from us. But in the meantime, let me just say thank you, each and every single one of you guys, for attending this webinar. I hope you've had a lot of value. I hope this has been very useful for you guys. I appreciate you all. Thank you. I hope you have an amazing evening, and I look forward to speaking to all of you guys again in the future. Thank you very much, guys. See you later. Goodbye.